All right. Hey, everybody. Good morning, good afternoon, depending on where you are. You are here with Mike Shorr. Welcome to Market Minds. I am sitting in for our CEO and my good friend, Scott Bauer. Got to meet with Charlie Moon and myself, and actually tomorrow we will be doing this together. So double trouble tomorrow for you folks. How's everybody doing? So just a little bit of an unchanged day. We've explored a little bit of the upside. We've explored a little bit of the downside. We had retail sales that came in today, basically right in line. Tomorrow, we really don't have much. Got some housing numbers and things like that. And we have expiration. Then, of course, we're going into the 3-day weekend. So we could see stuff. It could be, without a lot of market participants in there. Could see things get pushed around a little bit, or it could just be, kind of a settle in sort of day. But, pretty controlled, decent movement here today. So that has been good for us in the day trading stuff. How's everybody doing, Gilbert and Gene? All right, so today I wanted to let's talk about vertical spreads. And hopefully you can see that okay. So first let's start out, what is a vertical spread? What is a vertical spread? So number one, it can be done from the call or put side. We'll work on the call side. I always find that it's best to teach things first from the call side, and then once you get it, then you can let your mind flip it over. And it uses the same expiration for both legs. And it can be done from the debit or credit side. So for retail traders, this is one of the few ways that we can effectively and without hurting our buying power too much actually sell premium. But we'll start it with we'll look at let's look at a call, a debit call. If I can spell here. All right, let's look at, does anybody have a stock they would like me to use as an example? Time can be on our side. Theta is usually not, that's not the main driver. Theta, there is a tiny bit of theta, and depending on where you are in the expiration cycle, and it can be more, it depends where you are. All right, the first one that we got put out there was UNH. Okay, that was just first. Okay, UNH. Okay, are we bullish or bearish? Oh, let's just say that we're bullish. Let's say that we're bullish, just for fun. Okay, so we know from, if you guys were here with me on Tuesday, we talked about expected move. And let's say that we want to go out to UNH here. And let's say that we're looking at the chart, and I'm not saying that this is what I think. I haven't even really looked at the chart, although it was off this morning. Let's take a look at the chart just for posterity's sake. Okay, let's just say that this isn't bullish. I'm just saying, let's just say that we are bullish, just so we can use the most simple and relatable example. Let's just say that for whatever reason, we're bullish here. Like I've said, this is not bullish right now. Really not at any sort of support, and obviously with earnings, it's come off about almost 5% today. Okay, but let's say that we're bullish. Okay, so, and let's say that we want to go out. We want to go out to February, regular February, which would be the 21st expiration. So we know that from our discussion on Monday, and you can go back to our YouTube page and review that, but we know that we need 5 pieces of information. We're trading around 517.80. And we know that we want to go out to the 21st. That is the expiration. And we know that the implied volatility for that is 23.8. So they are pricing in between now and February 21st. Full standard deviation move is about 7.5% away. Let's just go with that. So we know that if 7.47% above 517 is going to put you somewhere in the 555, 560 area. For exact, it would be 556.50. Let's go out to regular Feb here. We're only going to have either $5 or $10 wide strikes. So let's say that we want to go to let's say that we want to look at the 540, 560 call spread. Again, this is not a signal of any sort. I'm just doing it for an example. Okay, so we know that given the standard deviation move, we're looking at somewhere between 550 and 560. You could roll it back and do a 530, 550, but we'll just look at the 540, 560. Okay, so we can see where that's trading. We know that we are buying the 540 call and we are selling the 560 call. So one way to look at a vertical spread is almost that you're financing the purchase of the lower strike call with the sale of the higher strike call, in this case, the 560. So that's going to be cheaper than just buying the call, which is trading for about $7.37.5. Market right now is $25.50, $7.25.50. Okay, so if we just look at the debit call, if we look at the 3D risk chart of that, and I'll make this a little bit bigger so you guys can see it. Okay, this is what a long call looks like, right? We'll push this out to close to the expiration date, get rid of all these guys in here. And so that just looks like a long call, right? Below the strike, you're going to give away your premium. At the strike plus the premium is your break-even price. And then theoretically, if UNH goes to the moon, your calls go to the moon with it. Okay, but instead of paying $7.50 for this, or whatever we have to pay for it, somewhere in the mid 750s, we're going to finance this by selling the 560 call against that. So what happens there? Let me just break that out. So if we get something, because we're lowering our premium, because we're going to collect premium from selling this call here, we're going to buy the 540s, we're going to sell the 560s. So we're going to take in a little bit of premium, not a little bit, almost half of the premium. So it's going to be about half of it as expensive. But what do we give away for getting that lower price? We cap our gains out at 560 or above. Because let's just say that we go to 600. Well, that's great for our 540 call. Not so great for our 560 call. In hindsight, you would have said, man, I wish I had just bought the 540 call. We don't have the advantage of having that time machine. And so we're going to go with a vertical spread, because the probabilities are telling us that going to 550, 650, that's a full standard deviation. So anyhow, instead of paying $7.30 or whatever for this call, we only have to pay about $4. $4.08 is actually mid-market on this thing. So approximately a little bit more than half as much to buy this. Exactly, Mark. You limit your gain. But we have a lower cost basis. So for the same amount of money, we can do more of them. We can do almost twice as many of them. Okay, so let's just say that we can buy these for $4. We can buy these for $4. Okay, so we're going to put our premium up here. It'll let me click in there. We're going to put in a -4 because it's a debit. We have to pay for this. Okay, so say the full SD move is 556.50. So we will look at the 221, 540, 560 call spread. Buy it at $4. Like I said, this is not a signal of any sort. I'm just using it for an example. Okay. What is the most we can make on this? What's the most we can make on this spread? Well, we can make the width of the spread, which is $10, or excuse me, $20, less the premium we take in. Not that we take in, that we paid, which is $4. So then what is our reward? Oops. What's our reward to risk ratio? Reward to risk ratio is whatever we can make, $16 divided by what we paid. Exactly, Clive. 16 divided by 4, that equals 4 to 1. Okay, so my and Scott's for that example is that we want to get at least 2.33 to 1 on a vertical spread. If we start to get north of 3 to 1, we can choose to, I'll just say, bring our strikes closer to at the money. So this will cost a bit more, but the probability of profitability is greater. Okay, so with this, with 4 to 1, I'd say, you know what? We don't need that much. So let's look at the 530, 550. Maybe we don't have to be that aggressive. So now this is going to cost us, it's going to cost us a little bit more, right? 530, 550, that's going to cost us $5.65 mid-market. $5, nope, $5.65. But now we can look at this, and we're looking at the 530, 550. We're going to buy one of these and we're going to sell one of these. And now we see that we've been able to roll our strikes up a full $10. And yet, what's the most we can lose? We can lose the $5.65. And the most we can make is still that $20 wide, but we're going to have to pay a little bit more for this. We got it for $5.65. We could make $14.35. So now we're getting a little bit north of 2.5 to 1. So clearly, I mean, if UNH is going to go to the moon, and then you wish that you had gone with either just a call by itself, which you don't know, or the 560s, which was kind of pushing it on what the expected move was over that time. So then it's just a matter of, well, you know, how aggressive do you want to be? If you want to be more conservative, you would roll back to the 530, 550. If you want to be more aggressive, you would do the 540, 560. But either one falls within our risk parameters. and the 540, 560 is actually really over. I'd rather roll it back $10 and only make 2.5 to 1, a little bit better than that, than hoping we rally another $10. It's just, that's the one in hindsight that you would say, well, tell me what's going to happen as we go forward in time, and I'll tell you which one I wish I had done. We don't have that advantage. If anybody does, please let me know. Okay, any questions on that? All right. Thank you, Mike. Mr. Clark just put the word of the day out there. Everybody who wants to be in the spinning wheel and win some nice prosper swag, throw in the word vertical. There you go, Gene. Get it going. All right. Do we want to look at maybe because we can do that. This is an example of a call debit spread because we're the ones paying the money up front, and then we settle up at expiration or before if we sell it. So we know that at expiration, if we're below the 530s, well, it doesn't really matter because obviously if we're below 530, we're not going to exercise our right to get long at 530. If we really wanted to get long the stock, we would just buy it wherever it was below 530. Where's break even on this spread? So 221, 530, 550 call vertical spread. We buy for $5.65. What is our break even price at expiration? What's our break even price? So remember, we're long the 530 call, we're short the 550 call, and we paid $5.65 up front. So essentially what we have to do, we have to recoup $5.65 of premium that we initially paid. Where does that happen? There you go, Clive. It's our long strike plus the premium paid up front. So our long strike is 530. We had to pay $5.65 a premium. That equals 535.65. We can see this here if we want to just put this in here at 535.65. We see that on these calls at expiration, the 530 calls, they're $5.65 in the money. We still have to pay, no matter what happens to this, we have to pay $5.65 up front. So those two things wash. So then anywhere above 535.65, now we're in the chips all the way up. So if we go to 545, well, now these calls are $20 in the money. We still have to pay the $5.35. So we make $9.35 on that vertical. Then, of course, if we go to 560, it doesn't matter if we go to 600. Well, still, we have $20 between our options, $20 of profit. We still have to pay the $5.65 to get in this. But then we get back to our 2.54 to 1, where we make $14.35. And clearly this can be done on the put side as well. I always find it that teaching stuff for the first time from the call side, The human brain is wired for calls, not wired for puts. Eventually, your mind starts thinking in puts. All right, what about a credit spread? Or if anybody has any other questions or other tickers that you want me to look at, we could do that too. Either way. From the credit side, where we are the ones collecting the premium. And then we settle up at expiration or when we exit. Okay, we're not doing straddles though, perspectives. Iron Condor can be 2 credit spread or 2 debit spread. You can do that from either side. But we don't want to start talking about Iron Condors just yet. Maybe we'll talk about that next time. We're talking about vertical spreads. We'll just keep it simple because all an Iron Condor is a combination of 2 credit spreads, put in a call, or 2 debit spreads. Or did I say debit already? You can do it from either side. Or you're doing them at the same time, either hoping that you get out of a certain range if you're on the debit side, or that you stay in a certain range if you're on the credit side. But let's say, let's just clear these out here. And let's just stick with UNH. So let's look at that UNH chart again. And let's say that we think that we are going to hold this 20-day moving average, which is at about 510. I'm just randomly taking this. So we could actually sell a put spread. So let's say that we want to do a $10 wide put spread in UNH. The $5, 510. Let me clear the strikes out of here. Okay, and this is just an example again, but in this case, we're going to sell the closer to the money. We're going to do this for Feb again. So we're going to sell one of these. We're going to buy one of these. And for this, we're going to be the ones, let's just say that we collect $4. Close enough. Okay, now we put in a positive number here because we're the ones collecting the money. Okay, so we're selling a $10 wide call spread for $4. Okay, what is the most we can make? The most we can make on this credit spread. Exactly, Clive. We can only make the amount of premium that we initially collected. That's in this case, $4. Come on. Now, what can we lose? What can we lose? Net, we can lose 6, right, Aubrey? We can lose the width of the spread, which is $10. Jeez. $10. Less the premium collected. So $10 wide, less $4 of premium collected equals $6. So now what is our reward to risk ratio here? If you did reward to risk, the most that we could make is $4. We can lose $6, which equals 0.6667 to 1. Or you can say we are laying 1.5 to 1 odds, which would be 6 divided by 4. So in the case of a credit spread, we're the one laying the odds, but there's more outcomes that could be potentially profitable for us to get max profit, right? As long as we stay above 510, so we could move down a little bit from here, we could stay right here, we could go up a little bit, or we could go up a lot, and we're going to collect our $4. The only place that we get dinged is if we settle below $5. Whereas in the case of the credit spread, you're taking a more active approach, and you're saying, not only are we going up, we're going up to at least this point and hopefully to this point or above. So in order for me to stick my neck out like that in a betting type of scenario, you're going to have to pay me odds for that because I'm the one calling the shots. Here, there's a bunch of, in the credit side, there's a bunch of outcomes that can result in a max profit. Does that make sense to everybody? Does anybody have any questions? Or does anybody have a ticker that they want me to look at now that we do have a few minutes left here? Want to know what my thoughts are on anything or the market in general? What my favorite color is? Twilio. Let's take a look at Twilio here. All right, I'll bring up my daily charts here and we'll look at Twilio. All right, so Twilio. Anybody want to take a gander if this is bullish or bearish? Wheel is closed. Thank you, Mike. I mean, this is obviously a bullish chart. So Twilio this morning was able to take out these highs here at 116.27. It has fallen back into this range, into the Donchian channel after making that initial run up. Market's down a little bit from where we were early in the day. So it's clearly bullish, but you're also asking for it to go make continued new, at least recent highs. When's the last time we were above? It's been a while. I'm surprised that's not a 52-week high. Let's look at the weekly chart here. Those are going back for quite a while. You're going back. Where are we here? 117. Last time we were in the 117s. You're going back to May of 2022. So, although it's bullish, you're asking a lot of it to continue to keep going. So this would probably be a no trade for me. You'd be looking for some sort of pullback. You know, clearly if it got back to the 50, you know, we haven't touched the 50 for going back to September of 2024. It's just been straight up since then. But I think you're asking a bit much for it. There's nothing bearish about it other than it hasn't been this high for a long time. But like I said, you know, you're really asking a lot for it to break up above that. If it does, you got, you know, keeps going. Let's do one more here, and then I think we'll be ready for the wheel. Let's do one more. PLTR, and actually Scott and I were looking at this today. So, I mean, the hurdle that we were looking at is, can it hold this 50? So, it'd been on a trajectory, basically, not straight up, but basically straight up. A little bit of wiggles in here. And then we saw that we put in 52-week highs up here at 84.80, and then we pulled all the way back here to basically 68.5, or we pulled back all the way to 63.5. But now we've taken back this 50-day moving average. That seems to be, this was a little bit of resistance here. Then yesterday we settled just above that, and we're able to hold it today. So I'm when Scott and I were talking about this earlier, this was kind of the green light here, this entering here at the 50. You're going to get some resistance here at the 20 because you saw support here at the 20, almost got to support here, basically got there, there. Then it kind of stalled, and then it finally came off. So you should expect a little bit of resistance here. That's up at 74. So if that's still a $6 move, a little bit less than 10%. If you get a pullback to the 50, and then if you get above there, then you're looking at 80.5 or so, and then obviously 52-week highs up at almost 85. But I'm certainly more bullish than bearish in PLTR. ATR is above, which is typically a no-no unless you're looking at a relatively quick hit, which would be fine. But if you're sticking to straight things, you ideally want this ATR to be below, like it was this whole time up. And then it finally took out those lows, put the ATR. So it's a little bit tenuous, but more bullish than bearish. All right, let's get this wheel of names here. Let me pull this in here. Lots of names. Thank you, thank you, thank you. All right, if everybody's waiting, here we go. Who do we got? Aubrey or Kent? It's Kent. Kent Von Hoff. Congratulations, Kent. Kent, are you here? Remember, you do have to be here in order to collect the Prosper swag. Kent, let us know if you're here, my friend. If not, we're going to have to spin again. Let's give a little count. All right, Kent, good, you're here. Congratulations. Send us an email. Mike, where should they send it to? Marketing or info? Or who should they send it to? Second. I'm just figuring out where the email should be. Screen. Oh, there you go. Sorry about that. So, Kent, email your shirt size and mailing address to Prosper Swag at prospertrading.com. Congratulations. All right. Any final questions before we get back to our trading day? Looks like we've traded off a little bit here. Nothing big down at the 2ST though. Looking there. All right. Well, everybody, I really appreciate you guys stopping by. Remember, Charlie and I will be on together tomorrow as Scott enjoys his well-deserved vacation. Everybody have a great rest of your trading day. Remember to keep that risk in check. And Charlie and I will be with you tomorrow. Have a great day, everybody. Be safe, be healthy, be kind to each other. And I'll see you tomorrow, if not in the room. Thanks a lot, everybody.